What is going on, everybody? Welcome back to another video. In this video, I want to go over the poor man's covered call and is it the right strategy for you? So with that being said, let's go on ahead, cue the intro, and get right into this video. Okay guys, in this one you guys know I love to use SPY, SPY, and this one we're going to use the Qs because it's a little bit cheaper. It's basically the same index almost, but this is mainly tech. But I like this one because I actually use TQQQ a lot for selling options, and I just wanted to go over this one because it's basically the exact same thing. So with this, TQQQ is the leveraged one. This is just the plain index on this. So what we're going to do is a poor man's covered call. And so the difference is you can actually do this in a couple of different ways is what people don't realize is you can do this kind of a further out, or you can do this more of a short-term trade as well. Now, this one is really going to depend on what your budget is and how you really think. So to do this, you are really going to have to make a decision. Are you long or are you short on this stock? Me, I don't like betting against the market. You guys all know that. That's why I like selling puts. If you're new to this channel, I sell a lot of puts, but on this one, we are going to go in. We have the options chain here. The first thing we're going to have to do is buy a call. In order for the poor man's call that's going to work is you are going to sell a longer call that has more intrinsic value, basically in the money, and then we are going to come back and sell a call at a shorter distance that is out of the money, basically. That way you have a little bit less risk, and you're just going to see that your first trade's not what's going to make you your money, but your second and third and fourth trade usually do. So with this one, we are going to go out, and this is how I do them when I'm going to do them. Right now, I am not, because I don't think we're going to have a very good quarter one. That is just my opinion. So what I'm going to do is I'm going to go, if I was going to do a poor man's covered call on QQQ, I'm going to go and I'm going to buy this 410 call. This one is in the money, or basically right at the money is what I'm going to do. And normally I would probably actually go one in the money and actually go down to like this 405. So it would give me a little bit more room. So, but for this purposes, we're just going to go barely in the money. It makes it a little cheaper for us. So I'm going to go to a 407, 404. Let's go to the 410 one for this example. And then I'm going to go out here, and a lot of times I do them every week. So I'm going to go to 7 days. And remember, this other one was the 410 call. That's something we need to keep in mind up here. And then we are going to switch this setting to sell. So now, of course, the price has to be above 410 that what we are going to sell for this to really make sense for us. And I'm going to show you the differences on how you can make this trade cheaper. So bear with me. This one is going to be a little bit more expensive. So what we're going to do is we're going to go to the 411 and we are going to sell because we're going to try to create as much premium as we can. You're going to see here, so your max loss is 2,369. That's if everything goes to zero. What you're going to be able to do is you are going to take this long call that we are buying and you are going to sell options against it because it's going to show that you have, this acts as your 100 shares of QQQ. Now again, this does bring a little bit of risk into it because you guys got to remember options are technically leverage. And they are contractual agreements to buy the stock. So 410 call here, it's going to cost you $2,750 basically, and then you're going to sell this 411 call for $270 basically. So your total cost is going to be $2,400. Now you're probably thinking that's a lot of money. Why would I make this trade? So the purpose of this is for this call right here that we are selling to expire worthless, and you are long the stock, so you guys know you are wanting the stock to go up. If it does get called away, you are going to make money here. You're not going to make a ton of money. You can see the graph in here. So if it does get called away, you are going to make money, and you're going this is a trade that I don't think everybody should make. I would much rather see you guys do a vertical, which is basically buying and selling the same date and collecting the premium. But again, if you guys are super long on this stock and you think this is a great idea with your money, this is just the poor man's covered call on how they do it. There's nothing wrong with this. Now, another thing that you could do, now let's get rid of both of these. And another way to make this trade cheaper, and I think that's one thing that a lot of new traders don't really look at, but you can do this, is let's go, I would like to go at least 45 days out. You can go 30 days out. I'm going to get out here to 38 days. I'm still going to buy the same one. You guys see that it's instantly cheaper because we're not going out as far in time. So the trade does have to work a lot faster. So if you are short-term bullish on this, this is probably the way you're going to go with a little bit of a cheaper capital. So, and then we are going to go back to 7 days. Or whatever date you want to choose here. I'm going to do this, and then I'm going to go back to selling this. And now we're instantly going to see that your max loss is less. It is dramatically less here. But you also have less time to collect premium on those options. And I think that that is a key point that a lot of people miss. So remember, we're looking at it's 410 right now here on the Qs. That is something you have to be mindful of. And I usually don't enter this strategy on green days. If I was going to enter it, again, I'm looking to enter this on a nice solid red day. I want a move down, and because that long option is really going to be the determination of whether you get to be profitable or not on this trade. You have to be right directional wise, or you have to have time on your side. That's why I don't like this shorter term trade here, because you're only giving yourself 38 days. Now, can this work for quick cash? Yes, but you got to remember what you are risking in order to make that quick cash. I think that's a very important thing that a lot of traders don't look into. Some of the trades that are a little bit longer ended, but have a higher probability of success in the long run, may cost a little bit more, but you're also technically risking less over time because you're going to be able to collect premium, and you're going to be able to reduce that capital that's being taken. And I think that's something not a lot of people look at. And I hate that they don't look at the big term, they're looking short term, but I understand it at the same time. So again, if I'm doing this, I'm going 6 months out because I want the most intrinsic value that I can get out of it. And I think it's going to be a rough quarter one. I think the numbers when quarter one comes out, I think it's going to be pretty rough this next year. I hope I'm wrong. I really do hope I'm wrong. But I do think that is the case. So again, if I'm doing this, this is how I'm setting it up. And then I'm coming back here at 7 days. And I'm going to sell this one. Now, another way that you can do this, instead of just getting the 266, you could go out to those monthlies and collect a little bit more premium. So we can go to 31 days, and you're going to see here, this will dramatically make it cheaper for you. So your max profit it's going to be a little higher than that one shorter term one, but your max loss now is showing less, and you're collecting $800 here. Oh, you see the 410 just came out of the money. So, oh no, it went in the money, my bad. So, with this one being here, you can see it's floating around that $410 range. That's where we were wanting it to be in the first place. But this is an $1,800 risk. So we are hoping that the stock continues to go up, it becomes worthless, and this long call that we bought is going to be our profit maker. Worst case scenario is the market just absolutely tanks. This call is going to get killed a little bit, but we're hopefully going to be able to keep our cost basis continuing to go down because we're collecting this $800. We're going to collect all of that after a month, and then we're going to go to the next month once this one expires and we still own this call up here. Then we are going to go and we're going to sell another call. Of course, you could sell the 410 at that point in time to reduce that cost basis, and that's how you can continue to turn it just like a covered call would. You just have to remember what your cost basis is, what your strikes are, in order for this strategy to work for you guys. I appreciate you guys taking your time out of the day. Please comment below if you have any questions. Always feel free. I'm always here to answer them all, and I will see you guys in the next video.